Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. The move up has finally finished, that much is obvious. Target X on the top side, the primary target for the break up and out of the July to late October 2022 descending triangle, which I'd highlighted in dark blue on my daily chart, was reached in late February, and the market did not have the energy for a further move higher to the harder reach target X1 at 1605. These two will now be retired after this commentary. The aberrant break below the bull channel from very late December last year, highlighted in red on my daily chart, that happened in late February, was repeated mid-March, though this time it was not an aberration, but the real thing. This was further solidified by the break below the declining long-moving average, currently at 1467 last week, and below the August 2020 to date uptrend this week, and that's currently at 1458. This uptrend will, like the earlier targets mentioned, will be retired after this commentary. The question now is what will be next. Now, you may say that all the action since last October is part of an ascending inverted scallop pattern, or you may say it's part of a bump and run reversal top pattern. And in both cases, I'd agree there are elements of both of these patterns here, but not enough to say it's one or the other. Hence, I chose to look at the longer term charts to see if I could gain a clue as to what will be next. What was interesting there was how much more important the August 2020 to date uptrend appeared to be, and perhaps most importantly, it was not the break below the 2019 to date bullish shift pitchfork, though that was significant. It was instead the possibility that we now have a February 2021 to date bear flag. This month's move below the lower tine and the uptrend has set up the opportunity. It would very much now depend on two factors. Will the market halt at the congestion at 1878, as formed the lower trend line of the sideways triangle from late last year? And if not, will it halt at the July 2022 low at 1304? If the answer is no to both, then we may well have a bear flag formation with potential down as far as the 1120 zone. That's quite a big move if it does come about. It's too early to look at these levels as targets as yet, but it's worth filing them away should the two significant support levels give way. Chicago soybean meal. As I've repeated here so many times, we have had here and have here still for months now different patterns, not so much melding in with each other, but rather crashing in and out of each other. The bigger pattern here is the May to date seemingly broken, then repaired, ascending, expanding wedge pattern. A huge pattern I pointed out many months ago. This had developed for a while, but is now looking pretty ill. It was never a perfect pattern by any means, but it had seemed to work until the end of last year. To assist in seeing this pattern, I've highlighted in dark blue. It's worth noting that the lower trend line is also the neckline of the huge December 2021 to June 2022 head and shoulders continuation pattern. That's currently at 419 even. I'm still thinking about downgrading it, as there's enough else going on nearby that deserves some closer and better attention. The next patterns to look at are the ones that caused the peak of the market in early and late December last year. It was a combination of the 2021 high at 471.40, inflamed, yes, I think that is a good way to describe it, inflamed by the neckline which I had previously highlighted in bright red of the February to April 2022 head and shoulders top, currently at 481.10. Now, I should perhaps clarify that the June 2019 high of 479.30 had also helped. Prices had since then, tried moving higher and away from the 2021 high, the June 2014 high, and even up and away from the bright red neckline. However, these moves higher brought the market into conflict with fresh resistances, such as the 2022 high at 491.5 and the 2014 high at 494.40. The market breached both of these, but was not able to break them. Now, looking below, we saw the market back in January drop down to just short of the April 2021 high at 439.30, where it gathered ammunition and turned back up in mid to late January. We also saw a smaller drop and recovery over the turn of February into March, supported by the short medium moving average, currently at 470.20. At the time, it gave the illusion to look at the late November 2022 to January this year action as a possible bullish halfway hesitation. Well, that idea even had some traction, with the largest such pattern dating from late November 2022 to mid-January this year, giving an initial potential topside target in the 484.40 area, which it managed to achieve, and a secondary harder to reach target, potential target X at 512.5, which it failed to even consider. Additionally, since the changeover in mid-January, had a smaller potential bullish halfway hesitation with a separate initial target in the 494.5 area, which the market managed to achieve, and a secondary harder to reach target X1 in a 513.5 area, which it failed to even approach. Thus, with both initial targets already reached, the secondary harder to reach targets will be retired after this commentary. This left us with what happened since the peak in early March and the subsequent move lower. The top of the market was a seemingly innocuous bearish harami formed 2 weeks ago. However, I suspect it was a combined key reversal down and bearish engulfing pattern made 2 Mondays ago that was really started to move lower. Enough that as we stand now, we are set up for a potentially monthly key reversal down. Thus, we close next Friday the 13th either over 468.5 or under 467.10, then we'd be on. Right now, we are most emphatically looking at a monthly key reversal down. This leads me on to the next question. What is coming next? Well, for this, I looked at soybeans themselves, much like I looked at soybeans themselves at the longer-term chart for soybean meal. Here we can see the potential monthly key reversal down, but also the possibility for a double top formed over fourth quarter 2021 to date. On this one, it will all depend on what the market does once it comes into close proximity to the 50% Fibonacci line for this move, and that's at 403.60. Should it get down to those levels, which it may do given what's been happening. Back to the more recent view. And you can see that yesterday was the first close below the long moving average, with a low on the significant ingestion at 433.5. Today, market seemingly trying to make a second consecutive close below that. What is in the immediate way below is the recent October 2022 today uptrend currently at 421.30 and the old neckline come lower trend line currently at 419 even of the ascending expanding wedge pattern. Now, given its past history, I suspect that neither of these two may be that much of a support, and it is the 50% Fibonacci line at 403.60 in amongst the congestion that stretches from 415.5 down to 400 even, that zone. That will be key to what is happening next, as long as the market secures good closes below the long moving average. Chicago soybean oil. The key recent features here have been the same for quite a while. They are now changing. Feature 1 is the lower time, currently at 62.41, of the December 2021 to June 2022 bullish shift pitchfork, which I have highlighted in dark blue on my daily chart. This lower time, along with feature 2, the April 2020 today uptrend currently at 63.47, which I've highlighted in bright red, both halted a decline in mid-December last year, started a small subsequent move higher with the help of the whole series of other supportive features, including the 2011 high at 61 even and supports at 59.44, 58.82 to 58.16, inside of which actually is the August 2011 high at 58.59 plus the September 2012 high at 57.64. Back in December last year, these all caused the market to revert back up and in the process form a small ascending wedge pattern. I've highlighted the pattern in bright green on the daily chart here. In late December, the market broke down through the base of the pattern, thus initiating a primary target in the 64.08 zone, and a secondary much harder to reach target X1 in the 58.82 zone. The primary target was easily reached, but it took until February to graze down to target X1 before being rejected back up again. Yet this rejection was not substantial, as prices did not manage to effectively push higher, stalling ahead of the 50% Fibonacci line, the January 2021 to April 2022 move at 64.10 and barely managing to regain the broken uptrend and the broken lower time before heading back down again. This time we saw a heavier move down to target X1 and through the supports below from 58.2 to 58.16. For a while, this congestion between 58.82 and 58.16 held up the market. But this week, the fall started again, with what turned out to be a bear flag pattern formed over this month, which has been the target below reached yesterday, with what looks like a possible weekly key reversal for this week. Thus, if we close tonight over 57.48 or under 56.61, then we'd be on. Right now, we're very much looking at a weekly key reversal down. Looking at the longer term chart, and we can see a topping action in formation, though whether it's a lopsided head and shoulders top or a lopsided diamond pattern is still a little open. What we can see is that the 51.10 to 51.20 area is key because of the low from December 2021. Below that, we seem to have a fairly free area until the 50% absolute Fibonacci line at 43.82. Just bear in mind, this is actually the longer term chart.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.